Target is one dividend stock down 38% that I think you might regret not buying on this dip here. Now in this video, I'm going to talk about why I think that's the case and try and explain why I think Target is one dividend stock you're not going to want to miss out on. So let's begin. Starting with Target's excellent revenue growth. Look at this quarterly revenue trend for Target going back 5 years. It's been moving on a nice upward trend. These fluctuations you see is because it's a seasonal business, right? Back to school and the holiday season tend to be busier times for Target than other times of the year. So you get these quarterly fluctuations. But if you look back to 5 years, that revenue is trending nicely higher, especially since the pandemic. The company was a prime beneficiary of the COVID-19 pandemic. It was deemed an essential retailer, allowed to stay open when competitors forced to close. Now, that may have been a short-term boost, but something happened during the pandemic that's going to give Target a long-term benefit, and that is the investments the company made in its fulfillment services. So it really invested in these, it really emphasized these services during the pandemic because people were less inclined to go shop inside of their stores. So Target really ramped up these three services: the shop online and pick it up inside of a Target store, shop online and drive to a Target parking lot and have an employee bring the item to you in the parking lot, and shop online and have the order delivered to you within an hour or two, or maybe three at the most. So these three same day fulfillment services proved to be incredibly popular with consumers, adding billions of dollars of new sales for Target. Consumers chose these options on billions of dollars worth of sales for Target, and I think that's going to be a tailwind long term, because this is, it's not just Target that saw that benefit. Walmart, Home Depot, and others offered similar services, and across the board, what you're seeing is that consumers have appreciated these options where you could buy online and then go pick it up at the store or have it delivered to your car. People want things faster, and that's proven to be the case here. And the another good thing about this is that Amazon will have a hard time competing with this, right? Because Target has 2,000 locations in the US, and same day within an hour or two is really really fast. And regardless of how fast Amazon is getting at getting your items to your doorstep, getting it to your doorstep within a couple of hours is going to be really expensive for Amazon to do, and it might be so expensive that it might not even bother trying. So this could give Target some protection over its business against Amazon for several years, and that's a really big positive that came out of the COVID-19 pandemic for Target. The next reason why I think Target is a good opportunity for dividend stock investors is because the company had a reasonably good operating profit margin, around 6% for the last decade. Now, during the pandemic, that exploded higher, over 8% for the highest it's ever been for Target, and it stayed there for a couple of quarters during a trailing 12-month period, and then now it's collapsed back down to 3.53%. This is a result of a mismatch of inventory. Target invested in a lot of inventory that was popular when we were spending time at home. Now that we're spending more time outdoors away from home, Target's having to slash those prices, offer discounts and coupons and promotions on those items to get them out the door, and that's causing its operating profit margin to dip in the short term. Management says that this is likely to be the case for the rest of 2023, but starting 2024, it expects to get closer to its long run operating profit margin average of 6%. That's understandable, right? It got a big boost during the pandemic, and now it's experiencing the reversal of that temporarily, and then it should settle back into its long run average of 6%. But because of this significant decline, the temporary decline in its operating profit margin, the stock is down 38%. So investors are getting an opportunity right now to buy Target stock during its temporary difficulties and capitalize on that pullback. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. The final reason why I'll give that you might regret not buying this dividend stock on the dip is the favorable valuation. The 38% decline in Target stock price has brought it down to trading at a forward price to earnings ratio of 15.56, which is around the lowest this stock has traded for, going all the way back to early 2022. So you're getting an opportunity to buy this stock at a good valuation. The company has made good investments in its stores to make them fit the way customers are shopping nowadays. And so after this temporary slowdown in terms of profit margin because of the discounts it needs to offer to better match its inventory to the way consumer behavior has changed, Target should go on for the next 5 to 10 years, earning a relatively solid 6% operating profit margin and growing its revenue in the mid-single digits, low to mid-single digits, which could provide dividend stock investors a healthy return over the next 5 to 7 years. So for all those reasons, I think Target stock might be one dividend stock you'll regret not buying on this dip here. All right, so that's all I've got for this video. Thank you so much for watching. I really appreciate your viewership. Please click on this video that I've got popping up on your screen right here. I think you're going to enjoy that. So please click on that, and I'll see you over there.